Hello and welcome to Inderes TV. We recently released an extensive report on HKFoods, a versatile food company from Finland, and today I'm here with analyst Pauli Lohi to discuss the company. Could you tell us what's most interesting about the report that we released?
Well, I think the key finding is that HKFoods is finally getting their operational performance together and gradually improving, and that's a result of improved ability to invest to the operations after decades of underinvestment.
And can you tell us a bit more about what the company does?
It's a large meat and food company in Finland. They slaughter, cut and process the meat from Finnish meat farms, and the retail channel is their most important sales channel, and they have several well-known consumer brands in Finland. They also sell their products to food service, industrial clients and to exports around the world.
Okay. And a bit about the business model. There's a strong integration with primary production, like you said, but who owns the production and how does the system actually work?
Well, they don't do any meat farming themselves, so they buy the meat from these contract farms. They have the operations to slaughter, cut and process, so that's their and of course market and so on and distribute to customers, but they don't do the farming. And what they do with the contract farmers is that they have some cooperation to help the farmers and ensure that they meet all the quality and responsibility requirements.
So the key is they process the raw product and then distribute it to resellers and restaurants.
And managing the meat balance sheet is very important, so that you don't end up with too much of certain meat products in your inventory, and when you have excess of some parts, then you have to export that to abroad and usually with very low margins or even with losses. So you have to manage the meat balance sheet very well.
And then geographically, apparently there's something like a bacon business in Poland, but they stopped their business in Sweden and Denmark. Is that true?
Well, they have been divesting their operations outside Finland in past years, and I think this is mainly due to the high leverage and the balance sheet situation that they have had to focus to Finland. They also retained the Polish bacon unit. I believe that they are not going to sell it, and that utilizes the raw material from Finland, but also from, for example, Sweden quite a lot, and they sell their products back to Finland and back to Sweden. So it's kind of in Finland we can say that it's domestic meat, but that's been processed in Poland.
Right.
And there's continuous customer relationship with Swedish business even after the divestment. But about the divested businesses, so Baltic operations were sold last year, and now in March this year Sweden was divested, and there's a deal to divest the Danish operations too, and that is likely to happen during this year.
Okay, yeah. So strong focus on Finland going forward then.
Yes.
There's a negative spiral with high debt, low investment capacity, and profitability challenges. Could you explain a bit about that? What's behind this? What's happening there?
Well, this is quite competitive industry, and the margins are rather low, so you have to have a high efficiency to make profits in this industry. And HK has for a long time suffered from high leverage and inability to invest enough to the industrial operations to maintain and improve the efficiency. So that's been burdening them not only in Finland but also in other these markets that are now divested. But after divesting those, they have been able to increase their investments in Finland, and also there's a positive trend in profitability already for a couple of years, and it seems that they are finally being able to improve their profitability more closer to industry averages. There's still lots of room to improve, but they are gradually getting there, I think so. And this is possible to due to focusing in Finland and deleveraging the balance sheet.
Okay. And what about long-term drivers and possible upside potential? Do you see any?
Well, the strategy highlights growth in growing areas such as poultry or food service segment, ready-to-eat meals, or more processed food components that can be sold, for example, the food service segment. So those growing areas offset the some decline in red meat consumption that is expected. I think the main upside potential is coming from improving the efficiency and profitability. So because the sales, it's quite close to GDP growth, honestly, in the long term.
Yeah.
So in the market, so we believe that improving the profitability is the key.
Right.
And they have done several measures in the past 2 years with total targeted savings, I think 12 million euros, and half of that was already achieved last year. And now the remainder 6 million euros are going to materialize from Q3 onwards. So,
okay.
So they are improving, and we estimate material improvement in adjusted EBIT from 12 million last year to 18 million this year and 22 next year. So they are improving from very low base, but quite fast.
Good.
Well, I also think that reducing the cost of debt is very important. They have close to 20 million euros of financing expenses this year, if you include also the interest payment on hybrid debt, which they cannot redeem yet. So the covenants of their debt contracts prevents them from redeeming the hybrid for now, and it will take, I think, a couple of years for them to improve their balance sheet so that they can redeem the hybrid, or maybe they could issue a new hybrid with a slightly lower interest rate, or use some equity-based solutions for that. But without any such solutions, I think it will take 2 years. And when you improve your EBIT and then decline or cut your financial expenses, then there will be some free cash flow also that you can use to cut your debts or pay dividends. So that's the key for long-term potential.
Okay. Yeah. And what's the valuation looking like at the moment?
Well, because of the financing expenses, you cannot look PE ratios to negative, but looking to EV/EBIT, which takes the balance sheet structure into account, it's 13 for this year and 10 for 2025. So I think that the valuation for this year's figures, it's expensive compared to other Finnish food companies, but with next year figures, it's more closer to fair level. But there are still uncertainty regarding the estimates or profits, owing to the challenges in the past. we still want more visibility on that, and we have to remember that they are not able to pay any dividend because of the financing expenses.
Of course.
So and the other companies we compare them are able to pay good dividends. So
right.
So it's not cheap enough yet. I think so.
And then finally, we initiated the coverage with a reduced recommendation. What would it require to improve that recommendation? What should happen? Of course, probably with the debt situation.
Yeah, exactly. So it requires continuous improvement in operational efficiency, that the industrial operations are efficient and competitive, and that helps them to grow the operational results, and then cut their financing expenses, cut the leverage, and finally continue paying dividends to shareholders. So that's what is needed, and it will take, I think, several years to them to match the dividend yield of other companies in this industry.
Okay, so there is room for improvement, but we have to wait for quite a while, probably.
Yes.
Yeah. Thank you, Pauli. And if you want to know more, you can go and read the report at inderes.se.